Hey everybody, I am here with my favorite local lender, Hans. It's Tamara Stone. Welcome to PDX Unicorn. If you've never been to the channel before and you like what you hear, please hit the like and subscribe so that you get notified every single time I drop a new video. Today we're going to be talking about rate buy downs.
Hey, so what we're talking about is a rate buy down as a better way to buy a house. It's better for the sellers and better for the buyers in this market. So instead of asking for a lower price from the seller, you're going to ask for a credit towards your closing costs, and you're going to use that to buy down your rate.
And we're going to explain to you what happens when you do that and your choices in terms of that as well. There are, how many choices do we have?
Well, we've got really three choices. There's a permanent buy down, a 2-1 buy down, or a 3-2-1 buy down.
So in terms of that, we're going to start by talking about if you were to purchase your house an offer price and an accepted offer price of $550,000. It's a nice round number. It happens to be our current Portland metro area median home price as well, so it helps. And then we're going to talk about it in terms of a 10% down payment, which equates to $55,000, and then a loan amount of $495.
$495, exactly.
So we're going to start with the 2-1 buy down.
Okay, so here's the deal. If using today's rates, you're looking at, if you have a fixed rate in the sixes, to get a better rate, if we do the 2-1 buy down, what it means is that the seller gives you about 2.1% of the sales price, about $11,550, and you take that money, that pile of money, and you use it to buy down the rate. The first year, your rate will be 2% lower, which will save you about $628 a month.
Which is amazing. I can tell you that I spend half that a week in groceries. So that's like 2 weeks of groceries,
yeah,
really.
Exactly. And so that's for the first year. And what ends up happening is if you picture that $11,500 that the seller gives you, we put it into a bucket with your name on it, and we put it over here, and we take the $628 a month and pull it out and pay the difference.
So it's like supplemental income, basically. It's like a savings account that's just for you that gets pulled out and put towards your monthly payment so that you don't have to come up with that cash for the first 12 months.
And then in the months 13 through 24, then the rate is 1% lower than the current market rate, and that's going to save you about $318 a month.
So we really need to stress, because it can be something that you get used to that monthly payment and then you don't remember, like, oh, next month actually my payment's going to increase. So
right.
This is something that some people kind of have a difficult time with, but you're still saving a ton of money. And if you can potentially refinance before.
That's the goal. This setup really helps if you're able to refinance in the first 2 years. Even the first 3 years, it's gonna be advantageous. In the third year, in month 36 through the life of the loan, it would be at that same initial rate, and so you would be no savings at all. Mm-hmm. But I talk about the fact that we put that money in that bowl and then we pull it out every month. So if in a year you're able to refinance, whatever money is left in that bowl is still your money, and you can use it to buy down your principal loan amount, and you can use it to pay for the refinance costs. That's really the bonus here on the 2-1 buy down.
Yeah, I think it's great that the money is just sitting in there. It's not a savings account that you really have access to. It is made and it's created in this third-party bank account so that it can only go towards mortgage-related things.
And the 3-2-1 buy down works the same way, but it's 3% savings, which is $918 a month savings for the first year on that loan. Of course, that's going to cost the seller about 4%, or $22,000. So that's going to be a little bit harder ask. That's where Tamara's expertise comes in, and what you can and can't get in this market.
Yeah, I think it's always going to be a case-by-case basis. You may not be able to get all of that, but being able to get some of it and then put in some of your own monies in order to also buy down the rate. Because it's not necessarily something that you have to get from the sellers, but it helps when you can. And so negotiating that is a big deal. Absolutely. But it's something that can be done on a case-by-case basis.
And the normal buy down is instead of buying it down 3 or 2%, you buy it down maybe 1%. That's a permanent buy down, and when you take that money, it's going to cost about the same amount as the 2-1 buy down. It's going to save you that $320 a month forever.
Right.
If interest rates never come down, then that's going to be the better one. But we don't have that crystal ball.
We don't. As much as we would like to, we do not.
And so we expect interest rates to come down as inflation eases. We've actually seen a little bit of an easing on interest rates. So we expect interest rates to come down in the next year. Nobody knows exactly how much, but interest rates will come back down.
Again, if you like this information and you're interested in hearing more from either myself or Hans, please feel free to comment below, like and subscribe. And we have more videos for you coming shortly. I did want to talk about a couple other things while I have you in terms of these sorts of things. I wanted to talk a little bit about which of these do you feel like is most beneficial to the buyer in terms of how much overall savings, because I don't know if you know this as the consumer, if you've never bought a house before, when you first are paying towards your mortgage, not a lot of it goes to the principal. A lot of it goes to the interest. So it takes a while before you start kind of chipping away at the principal amount. When you're thinking about how much you are saving with these rate buy downs, you in particular as the consumer, the purchaser of this, which one is going to save you the most money over time if you weren't to refinance? If you came in at the 2-1 and for whatever reason, which I'm sure you can attest to never happens, nobody gets into a 30-year fixed and stays with it for 30 years.
That never happens.
Doesn't happen. So what's, in your opinion, which one is kind of the best one to shoot for in terms of when you're trying to get this done?
The funny thing is that you ask which is the best one for the buyer, and the best one for the buyer is the 3-2-1 buy down, because literally you're getting a pile of money from the seller and you're able to use it, and it's going to be, the sooner you're able to refinance, the more valuable it is.
Because you have a bigger pile of money
because you have a
waiting
bigger
for you.
pile of money. And so I think the strategy is actually great for both buyer and seller, because if you as a buyer are looking at a $550,000 house and you think that you might be able to get it for $530,000 because we're in a different market, you're better off getting $20,000 or $22,000 from that seller as a credit to help you buy this house and to help ease you into it. And it's better for the seller as well, because, well, it doesn't actually matter for the seller. If they're going to give up $22,000 on the price, or $22,000, or they're going to sell it for more and give back $22,000.
Right, because we think about in terms of when you are selling your house, what you're netting out of the sale, right? So if your asking price is $550, and somebody says, well, I only want to pay $530, and you're like, okay, well, now in this market, I've been on the market for over 30 days. If I do a price decrease, I'm probably going to end up with even less than that. So, okay, sure, fine. But if you had somebody come to you and say, well, I'm going to give you full price on the realtor side, on the buyer side, we're like, yeah, comps look good. That house will probably appraise for $550, and then getting the $20,000 in seller credits to go towards your buy down.
Exactly. And some sellers,
dozen of the other, really.
Well, some sellers might want to use it as a marketing ploy. So like it's as like, hey, you guys, we're offering this at $550, but we're going to make it more attractive. It is more effective to use the seller's money in that way, and for the seller, it's the same. So it's just a matter of, and again, you're a real estate expert and what they feel makes sense in this market.
Yeah, I think 6 months, a year ago, during COVID times, when it was 100% a seller's market, right? And you had all these buyers saying, well, I'll pay you over asking, sweeten my deal with things like a 21-day close and, underwrite all of the things. Now it's kind of reversing, where kind of sellers need to market, and us as realtors also need to have a better marketing strategy towards getting your house sold before you're having to do any sort of price decreases, on top of making sure that you have good paint and are staged and all the things that make your house look really good, but also because the pool of buyers is much less and the houses are staying on the market longer, so people are kind of waiting. If you can entice them to pull the trigger faster with something like this on the sell side, I think it's a great idea. Okay, so we're going to talk a little bit about what happens if you don't get the full amount.
I'm thinking if we are asking for the full 22,000 and
Okay.
and 22,000 for a 3-2-1 buy down, or 11,500 for a 2-1 buy down, and you get somewhere in the middle. Well, you might decide to pony up some of your own money and go for the 3-2-1 buy down. But I think the better way to do that would be to take the 2-1 buy down and use the difference. Let's say you've got $16,000.
Okay.
Now you got $5,000 towards your
Leftover.
other closing costs that you would have normally had to put out of your pocket. So now you get to hold on to that in your bank account, and then you still have the 2-1 buy down. So it's the best of all worlds. That's my feeling, is that it doesn't have to be perfect.
Yeah.
There's only
There's always stuff that you can do with the surplus.
Yeah, and that's why I defer to the real estate expert, because people say, what's the normal? Like, how much off of the purchase price? Is it 5%? Is it 10%? What's going on?
Well, and a
It
lot of
depends
times
on
the way
house.
that we come up with that dollar amount is looking at the comparables. You know, if you're looking for a 1,500 square feet, you know, in this particular location, we can look and see what other comparables there are. And if yours kind of falls in the middle, okay, then it'll give us an idea as to how much we can really ask for. If they're asking a little too much up front, okay, well, you're asking a little bit too much for this house, so we're going to offer you, but then we're going to ask for it back in seller concessions in a variety of ways.
Yep, exactly. And each house is different. Each market is different. And so, again,
Yeah.
real estate expert.
Yes.
Mortgage expert.
Right. But teammates. So,
Yes.
and then it's nice because I can call Hans and say, hey, here, and you know, we're working off of this base dollar amount of the 550. Your house is not necessarily going to be 550, the one that you buy. So maybe it's 6, maybe it's 4, and I call Hans and say, hey, we're looking at putting in an offer at this. How much would it cost this particular buyer in order to get that seller credit to be able to do the 2-1 buy down or the 3-2-1 buy down? And in the reverse, the same way, I can still go to him when I'm listing a house to say, hey, what would be if we were to go to market at this? What would that buy down look like, so that we can always have an idea in our head what your net sheet will be as a seller. Okay, well, thanks for joining us at PDX Unicorn with Hans Brunner and Tamara Stone, and I hope that you like, subscribe, and comment, and let us know if there's anything we can do for you. We are happy to help. We make a great team, if you can't tell, and we love helping people from all walks of life, whether you're a first-time home buyer, an investor, you know, looking for your first, second, third home, whatever it is, we're here to help.
Yep. Thanks, you guys.
Thank you. See you next time.